A clear distinction to make you understand the difference between the return on equity, ROE, and the return on capital employed. Again, very simple ratios, but many of the times we tend to forget the basic formula, and we also tend to forget that is in which scenarios we have to use these ratios. Again, these are ratios and not multiples. They can be used in conjunction with multiples, especially the price to earning multiple and the price to book value multiple. The ROE can be used in conjunction with the price to earning multiple, and the ROCE should be used in conjunction with the price to book value multiple. So if I just tell you, the ROCE, the return on capital employed, it takes into account the operating profit adjusted with tax, that is the EBIT into 1 minus tax against the interest cost has not been paid yet. The EBIT adjusted with tax divided by the total capital employed, that is in terms of equity and debt. Now here we aren't subtracting the interest because this total operating profit or the EBIT is available to all the capital providers of the company, be it the equity holders or debt holders. ROE, the return on equity. In this case, we take into account the profit after tax, that is your EBIT minus interest minus tax. In this case, we divide the numerator by the shareholders' equity, that is only the equity capital. Why? Because the interest payment has been paid off already. The debt holders are satisfied. A debt holder always wants the interest commitment from the business. If me as a business has taken loan from a bank, what I'm paying to that bank is my finance cost and income for that bank. So bank will always compare, or my debt holders, be it in terms of some fixed income securities, bonds, debentures, long-term loan, short-term loan, will always compare my component of EBIT with the component of the finance cost. If my component of EBIT is higher than my finance cost, the banks are satisfied. My debt holders are satisfied. And that is the reason in case of the return on capital employed, we tend to take into account the total profit which is available to all the capital providers, be it the equity holders and debt holders, and not just equity, which we take in case of ROE. So always remember that whenever a company has debt, always use ROCE and never ROE. Because in this case, ROE might be a highly inflationary number and it can manipulate you because of lower base. So whenever a company has debt, always use ROCE. If no debt, then ROE is fine. But broadly, it's crucial to understand the major difference between ROEs and ROCEs.